we just don't spend any time in the financial media talking about bonds, right? We just kind of know they're out there. They are the most simplistic investment to make. Bonds are extremely easy, but because nobody talks about them, they seem like they're very complex, right? But they're not. You're just making a loan to somebody else, and they're going to pay you back your principal and interest. That's it.
The Real Investment Show.
Bonds are extremely easy, but because nobody talks about them, they seem like they're very complex, right? But they're not. You're just making a loan to somebody else, and they're going to pay you back your principal and interest. That's it, right? And your interest rate is simply a function of what the market, demands for the most part. And, that interest rate is set by, various things: economic growth, inflation, opportunity cost. Those are the things that kind of set the interest rate. And it's always interesting because there's all these other narratives that come about whenever there is a move in one direction or the other about interest rates. And, the latest migration of these narratives is the government debt, right? Because we've gone to $33 trillion in debt in the U.S. And, this is obviously the reason why, interest rates are going to just keep going higher from here. The only problem with that narrative is that, we've had trillions of dollars in debt for the last 40 years. And we didn't have an interest rate problem previously. So why now? Why is it just this magic moment? We just crossed some magic hurdle rate, and all of a sudden everybody goes, "Oh, well, it's the interest." It has nothing to do with the debt, right? It's economic growth, it's inflation, it's wages. That's what it is. So why are interest rates up? Interest rates are higher because if I want to make a loan to Brent, and I'm the government in this case, and Brent wants to borrow money from me, or I want to actually, technically, if I'm the government, Brent is the lender, right? I want to borrow money from Brent, and I'm the government. So Brent says, "Okay, I'll loan you money. I know you're good, right? I know you're going to pay me back." That's why treasuries are a risk-free investment. The government always pays its debt because we have a printing press. So Brent can mark off his list default risk, and because he knows he's going to get paid. So what other risk does Brent have to factor into his loan? Well, he's got to factor in inflation. Well, inflation's definitely higher than it was a couple years ago, so I'm going to have to charge more for that. Plus, I need to make a little bit of money above inflation, right? I can't charge 3% interest rates if inflation is 3%. I've got to charge something over that because I want to make some money. I mean, the whole reason that I'm loaning money to somebody is so I can make a return on my investment. So, but also have to factor in wages. Because if I'm a business, I'm paying wages to people. Wages have gone up. With all these stimulus checks and shutting down the economy and everything else that we did, we created a lot of demand in the economy with fewer employees, and that drove wages higher. So I have wages that I have to compensate for. If I'm a business owner, right, I've got to compensate for that. And I've got to compensate for economic growth because economic growth is where opportunity comes from. So if I'm going to loan money if Brent is going to loan money to me at some rate, he also has to evaluate, well, I could take that money and invest it into the economy and make more money, right? Opportunity. So I have to evaluate those. So that rate that is being lent at has to compensate for those things. It had nothing to do with debt because I'm going to get paid back. I have no default risk. Debt, the amount of debt matters when it comes to corporate bonds. Because if a company is heavily indebted, their default risk is going up, right? We don't have that risk in the U.S. And if you want a good example of what I'm saying, just go look at Japan and the amount of debt that they carry. 260% of debt to GDP, right? We're at about 113. Their interest rates are near zero. So interest rates are always a function of economic growth, wages, and inflation ultimately at the end of the day. There's about an 85% correlation between that index and interest rate. So yeah, it can vary, from time to time because of demand supply issues. One of the things that we've got going on now. But set aside those narratives that are not grounded in economic realities and focus on what actually drives yields over time, and that's the fundamental factors. But it's always interesting because, if we take a look at, what's been going on. So for the last 3 years, bonds have had basically a 50% correction. On the magnitude of a correction that we saw with stocks during 2001 and 2, as well as in 2008. Stocks corrected by 50% both times. So here we go. We're in the middle of a real bear market for bonds. And this is the longest bear market on record going back to 1787 for bonds. And yet nobody wants to own bonds. Everybody wants to own stocks. So you have bonds. Now think about this for a moment. Nobody wants to own a guaranteed payment of an investment because it's down in price and the yield is higher. So you're making more money by holding it. So nobody wants to own that, but in turn, they want to buy overvalued stock investments, which are currently running at one of the highest valuations that we've had historically going back to the 1850s. Now, this isn't surprising because this is how investor psychology works. And, this year is a good example of that. Everybody's been chasing technology stocks this year. Technology, communications, discretionary. So if we look at the top 10, top 7, 10, stocks, that's where all the returns this year for the market has been. This chart was as of Friday. So this chart didn't capture yesterday's move, but as of Friday, the market cap weighted index was up 11% for the year. The equal weighted index, which strips out the impact of the market capitalization of those top 10 stocks, was negative 1% for the year. So if you've owned other stocks in the market, you've had no return this year, right? Your return has come from 7 stocks primarily. But see, this is always psychology, right? We look at the S&P, we go, oh, the S&P is up, this much this year. So man, and bonds are down. So I want to own stocks. I don't want to own bonds. But again, as we take a look at that, this is the primary reason why over the long term, and Dalbar does this great study every year they put out on investor psychology and why investors consistently underperform markets over the long term. Now, that doesn't mean you should beat the market every year. You're not, right? Nobody's going to beat the market every single year. And this is why the worst thing you can do is measure your portfolio from January the 1st to December 31st and measure your performance. It's the worst thing you can do psychologically to yourself because it's going to wind up making you chase last year's performers, and you're always going to be on the wrong side of the trade. Look at it over a 3-year period, a 4-year period, a 5-year period. Have I done relative to my goals? Don't worry about the market. Market has nothing to do with you. What's your goal? I want 6% a year, 5% a year, whatever the number is. How have you done over a 5-year period? That's all that matters. Anything shorter than that, you're starting to just induce psychological impacts on your portfolio management. But again, we're trained by the markets to do this, right? It's like, oh, this is what the market did today and yesterday, and this is what the returns are since January the 1st. We're all geared to that, right? Because of the media. Worst thing you can do for managing your money. But this is why 50% of the reasons hurting, confirmation bias, loss aversion, and we go right down the list of all the psychological investor behaviors that lead to losses and underperformance in portfolios over time. The other 50% is you have your capital, you need it for something else, or you can't invest, or you don't have any capital to start with. But 50% of the reasons for underperformance of people that do have capital that invest, their losses and underperformance are almost entirely related to psychological factors. Now, what does this have to do with bonds being undervalued? We'll talk about that when we come back from the break and some of the important points about contrarian investing. Be right back. Don't go away.
You're listening to The Real Investment Show.
So Welcome back to the show this morning. Talking a little bit about investor psychology and why investors kind of always on the wrong side of the trade. You know, and again, timing is everything, as they say. And, you know, it's certainly understandable in the short term when things aren't working. You know, again, since we measure our performance from January the 1st to December 31st, if something's not working, it's like, oh, this is terrible. You know, this investment's not working and I'm not making money in it. And, you know, these things over here are making money, so I'm going to jump over there and do that. Well, you know, typically what happens is we kind of jump from the frying pan into the fire because what was working last year is not going to work in the coming year. Good examples of this, and we've talked about, you know, we've written articles on this. We've talked about on the show back in November of 21, oil prices had gone negative. And nobody wanted to own energy stocks because of, you know, ESG and climate change and all this other nonsense. And we said, look, you know, it's all about the money at the end of the day. And, you know, back in 1998, 1999, it was don't invest in sin stocks, right? We don't want to support those industries. So no gambling, no tobacco, alcohol, etc. Those were the best performing stocks during the dot-com crash. Right? Everybody wanted to be in dot-com stocks. Nobody wanted to be in fundamentally strong companies. Until where everybody was no longer the place to be. Same thing then, you know, same thing in 2021. We said, hey, everybody hates energy. Probably a place to be going into 2022. Positive returns all year, up 40%. Rest of the market was down 20%. It's always about where the money goes. And as soon as money shifted and money started chasing energy stocks and people were making money in energy versus other stuff, guess what happened to the whole ESG theory, right? Went right out the window. It's like, Same thing happened to the sin stocks, by the way. Nobody want, you know, the whole don't invest in sin stocks died a brutal, ugly death, just like ESG did. Has nothing to do with climate change or anything else. These were narratives put in place in order to generate returns. And, you know, we talked about the fallacies of ESG numerous times. People were charging 4 times as much to give you an S&P index return. It made no sense. And that ultimately investors figured that out. But, you know, chasing that, you know, ESG mantra wound up costing you money. Same thing in November of 2022 in the midst of the bear market. FAANG stocks are dead. Right? This year, can't get enough of them. In fact, that's all that people want are the FAANG stocks. Nobody wants any of the other stocks. So it's always the narrative of when everybody hates something, right? That's probably the time that you want to start thinking about owning something. And, you know, particularly when it comes to bonds that have a guarantee of repayment, there is a fundamental underpinning to those investments that stocks don't have. Stocks can go to zero. Bonds can't. Not government, not treasury bonds. Corporate bonds, yes. You know, other type of non-guaranteed corporate, community, municipal, whatever. Those bonds can go to zero if there's a default. Government bonds don't go to zero because they have a guarantee of repayment from the government. So, you know, what drives interest rates on the long end, what drives interest rates on the short end, 2 different things. We've talked about this numerous times before. But, you know, importantly, when we look at valuations, and we talked about stock valuations earlier, right now everybody wants to own equities, but they're super expensive. And bonds are very cheap relative to historical values and cheap relative to the economy and what's going on at the moment. And so you have this historic gap in valuations, but yet nobody wants to own the undervalued asset. Everybody wants to own the overvalued asset. And again, this is psychology. I'm chasing what was performing and I'm ignoring what isn't performing. And yet there's a fundamental valuation argument on bonds that is being grossly overlooked. And I know we've talked about this numerous times, but, you know, again, there's just this consistent narrative of misinformation that is out in the world. And the latest misinformation of this is that, well, you know, we just have too much debt, so that means interest rates have to go higher. And that's not how it works. Because, again, bonds are a function of interest rates, economic growth, and inflation. Now, now, if you could X out all of the psychological side of bonds would always theoretically match economic growth, wages, and inflation. So whatever that number is, that's what yields would be, right? It'd be an almost exact match all the time. If the stock market didn't have any human influence into it, it would be basically a set number most of the time because nobody would be buying or selling. This is the whole, kind of the whole fallacy of, passive investing. Oh, we're just all going to buy stocks and we're going to buy this ETF and we're all just going to hold it. We're just going to be passive. Nobody's going to buy or sell anything. If that was the case, markets would just be flatline. They wouldn't go up or down. What makes markets go up or down and what makes bond prices go up or down is the psychological impact of people trading. And right now, you have in interest rates a detachment of bond prices versus the underlying valuation because of massive shorting. We talked about this last week. You have massive short positions, so people are selling bonds they don't even own, so it's creating selling pressure on bonds, driving prices lower, yields higher, outside of what they would be normally. It has nothing to do with the amount of debt. It's just that there is a trend of prices that these computerized trading algorithms and hedge funds and others are taking advantage of, and they're driving these yields up and prices down because they're making money with it. Now, the issue with that is that when it reverses, they're going to become net buyers rather than net sellers. So this whole thesis, again, is wrong that, nobody wants our debt. We have just too much debt, so there's this dearth of buyers. No, there's plenty of buyers out there. Right now, they're just net sellers. But when they become net buyers, because prices are reversing, they're going to fuel that price reversal higher. But this is why bond prices move up and down over time. This is why yields go up or down over time. It's the impact of what's happening within the economy and the markets. So, this just goes back to the basic premise of, contrarian investing. And I just want to read to you a quote, and this is one of my favorite quotes about contrarian investing because this applies specifically to where we are right now. Resisting and thereby achieving success as a contrarian isn't easy. Things combine to make it difficult, right? So if you've been long bonds this year, as we have, right? We have a fundamental thesis about owning bonds and portfolios, but it's been a difficult year, no doubt. Because as bond valuations kept getting cheaper and cheaper, we kept adding more and more to our bond portfolio, and we're going to continue to do that. But here's the important part of this quote. Things combine to make it difficult, including natural herding tendencies and the pain imposed by being out of step, particularly when momentum invariably makes pro-cyclical actions look correct for a while. Sound familiar? Given the uncertain nature of the future and thus the difficulty of being confident in your position is the right one, especially as price moves against you, it's challenging and lonely to be a contrarian. And that's absolutely the case, right? It seems like right now that, yields just won't stop going up and bond prices won't stop going down. You've had 3 years of a bear market in bonds and a 50% decline. And, it's interesting because if we go back to 2009, in February of 2009, I wrote an article called 8 Reasons for a Bull Market. Nobody at that moment believed we were about to have a bull market in stocks. Stocks were down 50%. The general attitude was the stocks were going to zero. There was no bottom for stocks. There was no upside for stocks. Nobody wanted to own stocks at all. And of course, March 9th, 2009 was the bottom for the next 13 years. But here we are, 3 years into a bear market, 50% decline in bond prices, and everybody believes what? There is no bottom for bond prices. They're never going up again. Psychology is a difficult factor to navigate within your portfolio, but that's where opportunity exists. Howard Marks also stated this: in good times, skepticism means recognizing the things that are too good to be true. Think about stocks. That's something everyone knows. But in bad times, it requires sensing when things are too bad to be true. People have a hard time doing that. The things that terrify other people will probably terrify you also, but to be successful as an investor, you have to be a stalwart. After all, most of the time, the world doesn't end. And if you invest when everyone else thinks it will, you're apt to get some bargains. Howard Marks. All right. Wraps up our conversation. Stock buying and valuations. It's on the website now with all the attentive charts, quotes, etc. So if there's anything in there you liked, it's on the website right now, realinvestmentadvice.com.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.